When you walk past institutions like the State Bank of India, Punjab National Bank, or the Reserve Bank of India, you are looking at colossal financial pillars. Millions of people rely on them. They project permanence, absolute structure, and deep government roots. But if you trace the blueprints of this massive, centralized financial behemoth back to its foundation, you won't find a democratic master plan. You won't find a newly independent government carefully designing a banking system for its citizens. Instead, you have to go back to the 18th century, to the British East India Company. At this point in history, the company was strictly a trading corporation. Their entire business model was arriving on ships, extracting raw materials like cotton and spices from the local Indian markets, and selling them back in Europe at a massive markup. But the British faced a severe logistical bottleneck. They were foreigners attempting to navigate an incredibly complex, labyrinthine network of decentralized local bazaars. They didn't speak the language, didn't understand the local economic customs, and simply finding the right suppliers was a massive, inefficient drain on their operations. The foundation of India's modern banking system started right here. It was a desperate, improvised attempt to bridge the physical gap between British cargo ships and the chaotic local markets. To solve their supply chain nightmare, the British East India Company enlisted wealthy local merchants, historically known as Seths. These merchants were contracted to set up agency houses, essentially middleman operations that possessed the local language skills and market knowledge the British lacked. This chart shows the intended flow of goods. Local merchants procured spices, delivering them to agency houses, who transferred inventory to British warehouses. But the company demanded massive volume increases. The system broke. Merchants simply lacked capital for more inventory. To keep the spices flowing and avoid losing their lucrative contracts, the agency houses engineered a financial hack. They started offering short-term, interest-bearing cash advances directly to the local merchants. Merchants bought more goods, agency houses earned commissions, and the British filled ships. The very first step towards institutional banking in India was simply a credit line created to lubricate a physical supply chain. There was just one problem. The agency houses only had so much of their own money to lend, so they took a radical step. They opened their vaults to the general public, accepting deposits in exchange for a modest interest rate. This organic pivot created a core banking model driven by arbitrage. Arbitrage is the financial practice of taking advantage of a price difference across markets. The agency houses paid a low interest rate to the public for their deposits and charged a much higher interest rate to the merchants for their supply loans. The wealth generated by this spread was explosive. The British East India Company quickly realized what was happening. Their own logistical middlemen, the agency houses, were pulling in vastly more money through financial arbitrage than the company was making on the actual physical trade of spices. The company aggressively moved to cut out the middlemen and capture that profit. They established their own massive presidency banks in Bengal in 1806, Madras in 1840, and Bombay in 1843. The end result of this was an immediate monopoly. Over 400 independent agency houses were crushed by the company's financial weight or forced to become subservient branches of the presidency banks. This immense consolidation eventually forced the British to pass the 1860 Joint Stock Companies Act, a law that finally allowed private Indian-owned banks, like Punjab National Bank, to enter the market decades later. What had originated as a decentralized, localized network of merchant credit was now forcefully consolidated into massive, British-controlled institutional pillars. By 1914, the outbreak of the First World War sent massive economic shockwaves through the Indian economy. General panic set in. Citizens rushed to pull their cash out of the system, triggering bank runs that caused a domino effect of regional bank failures. To stop the bleeding, the British government executed an emergency response in 1921. They took the three giant presidency banks and merged them into a single unified behemoth, the Imperial Bank of India. But just a few years later, the 1929 Great Depression hit. It triggered a decade-long global crisis. Bank failures were reported worldwide, and the shock proved that even the combined weight of the Imperial Bank of India was not enough to secure the system on its own. The British realized that sustaining a wealth-extracting empire required a central, untouchable regulator, with the authority to shield the entire commercial banking system from external shocks. The legislative solution arrived with the RBI Act of 1934. 1 year later, in 1935, the Reserve Bank of India officially opened its doors in Calcutta. This diagram illustrates the absolute authority granted to the new institution. The RBI was placed at the very top of the hierarchy. It was given the power to dictate monetary policy, and crucially, it became the only bank legally allowed to print paper currency, stripping that power away from the massive commercial banks below it. Modern Indian banking stands as the evolved result of a foreign empire's logistical repairs and its desperate efforts to protect extracted wealth from global instability. But the 1935 establishment of the RBI carries one final, jarring anomaly. Despite holding supreme authority over the money supply of an entire subcontinent, the Reserve Bank of India was not a government entity. Unlike the Bank of England back in Britain, the early RBI was an entirely privately owned corporation, which leaves a massive historical question. Why would the British Crown construct a supreme central bank only to hand total control of it to a group of private shareholders?